Welcome to the Consumer Financial Protection Bureau's Housing Counseling Training in Phoenix, Arizona at the Burton Barr Central Library. The Consumer Financial Protection Bureau, or the CFPB, is an independent federal agency whose mission is to help consumer finance markets work by making rules more effectively, by consistently and fairly enforcing those rules, and by empowering consumers to take control over their economic lives. My name is Zixta Martinez. I'm the Associate Director for External Affairs at the CFPB. Today's event is being live streamed on our website at consumerfinance.gov, and you can follow CFPB on Twitter or Facebook. You can file a consumer complaint at consumerfinance.gov by U.S. mail, fax, or by calling 855-411-2372. That's 855-411-2372. Let me spend just a minute telling you about what you can expect at today's training. First, we're honored to be joined by two special guests that will be providing welcoming remarks. In just a minute, you'll hear from Arizona Attorney General Tom Horne and Superintendent of the Department of Financial Institutions, Lauren Kingery. Then you'll hear from the CFPB's Director, Richard Cordray, who will provide remarks about some of the mortgage rules that take effect today. Following Director Cordray's remark, you'll hear some homeownership stories about things that have unfolded in Arizona. Finally, the CFPB's Kathy Mansfield will lead a training session for housing counselors aimed at providing information about how the CFPB's new mortgage servicing rules may help consumers who are struggling to make ends meet. We're also pleased to welcome bicameral congressional staff from across Arizona, including staffers from the offices of Representatives Ron Barber and Kirsten Sinema, as well as staff from the office of Senator John McCain. So why don't we get started? First, I'd like to introduce Arizona Attorney General Tom Horne. Tom Horne was elected Arizona Attorney General in 2010. A.G. Horne was a litigation attorney in private practice for more than 30 years. During that time, he also served as a Special Assistant Attorney General, Superior Court Judge Pro Tem, and Court of Appeals Judge Pro Tem. While practicing law, A.G. Horne served on the school board of Arizona's third largest school district for 24 years, including 10 as its president. He served 4 years in the Arizona legislature, was a member of the Judiciary Committee, and was chairman of the Academic Accountability Committee. On July 11, 2000, the Arizona Republic wrote, "Tom Horne raises the level of debate at the state legislature by several notches, all by himself." He served as the elected Arizona State Superintendent of Public Instruction from 2003 to 2011. Attorney General Horne and his office remain committed to protecting Arizona homeowners from illegal lending practices and providing the best resources to support homeownership in Arizona. Attorney General Horne.
I am pleased to be here to welcome all of you, and especially Director Cordray, for coming to Arizona to discuss critically important new protections for consumers. For many years, Arizona was ground zero for the housing crisis, and thousands of borrowers were victims of scam artists and deceptive practices by lenders and servicers. Thankfully, the economy and our housing market is making a welcome recovery. But we are vigilant and determined to make sure that everyone, consumers and lenders alike, share in the responsibility to prevent a similar crisis in the future. The Attorney General's office played an active role in determining the outcome of the national mortgage settlement. And in fact, Arizona itself didn't settle till late at night, the night before the national settlement was announced the following morning, because we felt we deserved more than our pro rata share based on population of the settlement, because we were hard hit. And we ended up with $2 billion, which was 4 times what we would have gotten based on population. And that $2 billion has been a welcome infusion into our economy and helps in keeping people in their homes. And we continue to be one of the select states on the monitoring committee. I have a dedicated mortgage settlement team focused on resolving consumer complaints, a robust outreach and education effort to provide resources to struggling families, and an aggressive enforcement effort to prosecute consumer fraud. We have allocated millions of dollars from the National Mortgage Settlement to a wide range of programs, and it's working. Some of the funds available to us are providing funding to 16 counseling agencies throughout the state, contracts with legal services, a unique loan fund, relocation assistance to help families at risk of homelessness, and of course, direct aid to help keep families in their homes. They are accomplishing my primary goal of keeping families in their homes. An example is our innovative $20 million bridge loan program administered by Neighborhood Housing Services of Phoenix. Borrowers who have experienced a temporary hardship can apply for a modest loan to bring them current and seek a loan modification or refinance. They must utilize the professional services of trusted, HUD-approved housing counselors. By using the National Mortgage Settlement to fund housing counseling and the Arizona Mortgage Relief Loan Fund, we are making a real difference in the life of Arizona families. And we are going to communities all around the state to let them know what funds are available so that the people who need those funds will be able to apply for them, will be knowledgeable about what it is that we offer. The new CFPB rules that become effective today provide important consumer protections and promote greater transparency in the market of the future. Although the 5 big banks have been subject to strict servicing standards under the National Mortgage Settlement, these new rules apply to a wide range of financial institutions and will benefit all consumers. It's about responsiveness and responsibility, basic values we have a right to expect. We're talking about common sense practices that will increase protections and be safe for consumers, with fewer surprises and an expectation that reliable help is available. And we need tough standards now as much as ever. My office is still seeing servicers foreclose on borrowers who are trying to work out on a loan modification. We are still seeing servicers shuffle borrowers from one customer representative to another. And servicers still don't clearly tell borrowers which documents to provide in order to avoid foreclosure. It's time these practices stop, and we are dedicated to making sure that they stop. In addition to the servicing standards, another important regulation incentivizes lenders to provide qualified mortgages at origination. These are loans designed to ensure that the borrower has the ability to repay. And we don't have risky features like interest-only payments. These rules will enhance our state-federal partnership in our combined effort to fight against mortgage fraud. However, it is a shared responsibility also requiring credit-worthy customers to apply for loans they can afford to repay. Ultimately, financial institutions and our economy will benefit. Director Cordray, thank you for being here today to share our thoughts and provide this training opportunity. I think you'll agree that we have a dedicated, talented, and passionate community of advocates and service providers. A special thank you to all of you for attending today and for working tirelessly on behalf of the people of Arizona. Thank you very much.
Next, I would like to introduce Superintendent of the Department of Financial Institutions, Lauren Kinry. Superintendent Kinry was appointed by Governor Jan Brewer as the banking superintendent for Arizona on April 5th, 2010. Prior to his appointment, Superintendent Kinry spent 39 years in commercial banking with both community banks and large multi-state regional banks. Over his career, he has managed both small banks and large divisions from one location in a single community to multiple banking locations over a 7-state area. As superintendent, he is responsible for overseeing licensure, supervision, and regulation of state-chartered financial institutions and enterprises in Arizona. The department serves approximately 3,800 entities licensed to conduct business in the state of Arizona. Superintendent Kinry is recognized as a leader in the field of banking. On April 1st, 2013, he was appointed as a member to the Federal Financial Institutions Examination Council's State Liaison Committee. He is also a member of the Conference of State Bank Supervisors, where last year his peers elected him to serve as treasurer on the executive committee of the CSBS conference. Superintendent Kinry.
Good morning, distinguished guests, Director Cordray, Attorney General Horn, CFPB officials, AG officials, members of the public, and dignitaries. As mentioned, my responsibility is to examine and to supervise the financial institutions of Arizona, which not only include the state-chartered banks and state-chartered credit unions of the state, but also now a total of 11,000 licensees that many deal with mortgages and mortgage servicing. I'm pleased to be a part of this event and pleased to have Director Cordray and his staff and team in our state to brief us on the new law that's going to be in effect today. The message is of great importance to many in this audience and certainly great importance to all of the financial institutions in our state. I'm also pleased to report to you that from my perspective in Arizona, we have convincing signs of recovery from a tragic 5 years of unbelievable economic activity. We are open for business. We're open for mortgage business, and we look forward to providing leadership in the business of real estate financing and servicing in the future. I'd like to speak for a moment, though, on the state and federal coordination that I believe is driven by Director Cordray's leadership. Director Cordray and his staff at the CFPB have become true partners to me and my fellow state regulators across the country. In fact, the very first agreement that the CFPB signed in its first days was with state regulators. Last year, the states formed a partnership with CFPB focused on coordinating our independent supervisory responsibilities. Moving forward, there must be continued coordination and consultation between the federal and state regulators to best understand how local, state, and national economies are affected by the very regulations and the very legislation that is being put into effect today and days to come, and at the local level and our consumers are understood how it's going to be affecting them. This state-federal partnership leverages the strengths and the resources of both state and federal regulators, an acknowledgement that has already proven that we can do more together than we can apart. So a great example of this is the coordination that was seen just recently in the settlement that state regulators, state attorneys general, and the CFPB took with the Ocwen event, one of the nation's largest mortgage servicers. State regulators, in conducting examinations of Ocwen, uncovered troubling practices. We coordinated with state AGs and the CFPB to deliver a significant settlement that made a difference in consumers' lives. Arizona played a significant part in that settlement, which was just executed last month. As a result of our examinations and the coordination between state and federal settlement and federal associations, more than 10,000 consumers will receive checks to assist them as they transition from foreclosure. The people of Arizona will receive more than $20 million in loan amount reductions that will reduce monthly mortgage payments and help people stay in their homes. This is a tremendous first step and a great example of state and federal coordination and federal and financial oversight. CFPB, state AGs, and state regulators have all worked together to protect consumers and ensure servicers are operating in a safe and sound manner. Joint settlements such as the one I've just described cover a majority of the market. They creating a 21st century standards for the mortgage servicing industry. Servicing standards from the settlement include common sense process, such as ensuring documents are accurate, overseeing foreclosure attorneys, following the law, and restricting fees to those that are actually allowed by law and by contract. But more needs to be done, and we recognize that. So the servicing rules that go into effect today supplement these service standards that I spoke of, providing borrowers with needed clarity about their loan to better prepare them to meet their own obligations. These rules are also clarifying expectations for servicers. Further CFPB exemptions from the rule appropriately recognize the relationship-based business model of small servicers, including community banks and credit unions. Community institutions like these have served their customers well during the foreclosure crisis, and tailoring rules for these institutions should continue to be a priority for all of us, including CFPB. The CFPB appropriately recognized the benefits of the portfolio lending within our communities and created a small creditor qualified mortgage. Community institutions that keep the mortgages they originate check the borrower's ability to repay not as a regulatory exercise, but as an underwriting and a risk management requirement. So once again, I thank you. I thank you for coming to our state, Director Cordray, and your team to share with us these important rules. I would encourage you to take a moment, if you can, to enjoy Arizona while you're here, for at least to see what we're all about, but also to warm up from where you've come from in Washington. Thank you.
Thank you, Superintendent Kinry. Thank you for the invitation. It is a lot warmer in Arizona than in Washington, D.C. I'm now very pleased to introduce Richard Cordray. Prior to his current role as the CFPB's first director, Richard Cordray led the CFPB's Enforcement Office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In this role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect consumers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as an Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. Director Cordray?
Thank you, Zixta. And for those of you who are watching this streaming and aren't fortunate enough to be here today, we're at the truly beautiful public library in Phoenix, Arizona, and a very welcome setting for us to engage in the Housing Counselor Network and training, which we're doing across the country. So thank you and welcome to the Housing Counselors, Legal Aid Attorneys, Attorney General Tom Horn, and I, as Zixta mentioned, was an Attorney General myself, and so appreciate the work that he does and he and his office do every day and we work with them at the CFPB on a number of matters, and it's been a terrific partnership for us, and it makes all of us, I think, more successful in our work. And I also want to thank Superintendent Kingery for being here today, and as he mentioned, We've gotten off to a very strong start with the Conference of State Bank Superintendents and Supervisors. That has been an important partnership for us. As he mentioned, we just worked together to resolve matters with Ocwen, the largest non-bank mortgage servicer in the country, building, frankly, on work that was begun and moved along very effectively by the state bank superintendents around the country, and leading ultimately to a resolution that will help many, many homeowners stay in their homes with principal reduction. So thank you again for joining us in that work and leading that work. And let me thank all of you and extend a warm welcome for joining us today. When people are making decisions about buying a home, they deserve the best possible guidance. Housing counselors and legal aid lawyers provide that sort of impartial advice, and you also offer much needed help with rental and credit issues. But you also have been invaluable advisors to many homeowners in trouble. In fact, you are, to my mind, and I saw this in local and state government in Ohio, the unsung heroes of the foreclosure crisis, which would have done much greater damage to American consumers and American communities if not for your persistent service to those in need. We all know that particular work is not finished. You still stand in the breach to support millions of homeowners who are struggling with their mortgages and may be in imminent danger of losing their homes. All of us at the Consumer Financial Protection Bureau, both those of us here today and everybody back at our headquarters and our examiner crew who are scattered throughout the country, we salute you for the important work that you do every day, and we appreciate it. Today, I'm happy to say, is a big win for you and your clients across the country. It is the day that our new mortgage rules go into effect and become the law of the land. As we look back over the years before the financial crisis, we can recognize what the famous architect Frank Lloyd Wright once said: "There's nothing more uncommon than common sense." That quotation epitomizes the heady years preceding the financial crisis of 2008. Reason and sound judgment were absent when many banks and other mortgage businesses lent to consumers without even considering whether they could pay back the money. The supposedly rational market had become wildly irrational. Then, as you witnessed firsthand here in Arizona, it all blew up. The collapse of the housing market destroyed jobs in every economic sector and wiped out big chunks of people's hard-earned assets in every community across the country. Out of this mess came demands for financial reform, and among other things, the creation of the new Consumer Bureau. Consumers want and need someone with the authority to stand on their side and provide reasonable safeguards against bad mortgage deals that ruin their credit, cost them their homes, and saddle them with problems that follow them throughout their lives. While many areas of the country are now recovering and the economy is growing again, and I think that's correct, we must not forget those who are still struggling, your clients that you see every day. We decided to come to Phoenix to kick off these new mortgage rules because this community knows all too well the heartaches of troubled home ownership. 1 in 5 Arizona homeowners with a mortgage still owes more than their home is worth. Across the country, that number is roughly 1 in 10. As housing counselors, you know this means more than just having a hard time paying the bills. It also means stunted lives where people cannot move or sell their homes. Others may be embarked on a great struggle just to keep from losing their homes because they cannot keep up with their mortgage payments. Throughout the United States, 2 million households, we estimate, still remain at high risk of foreclosure. These troubles did not come out of nowhere. These people were victims of a broken system with deeply tragic consequences. And today we're doing something about it by taking a back-to-basics approach to mortgage lending practices. No debt traps, no surprises, no runarounds. These are bedrock concepts backed by our new common sense rules which take effect today. The first back-to-basics approach addressed by our new mortgage rules is no debt traps. For most people, their mortgage is the largest financial obligation of their lifetimes. But it can be difficult to figure out how much house and how much mortgage is the right amount. It's easy to get confused by the intricacies of taxes, escrows, interest rates, private mortgage insurance, changing monthly payments, and various fees. So most people rely on the professionals to tell them how it all works. And they assume that the lender will not lend them money unless the lender is confident they will be able to repay the loan. They believe this all means they're positioned to make a responsible decision they can live with for decades, not be lured into something that will bring them financial ruin. In the lead up to the crisis, though, some mortgage businesses stopped their inquiries well short of the kind of due diligence needed to lend money responsibly. Some joined their customers to engage in wishful thinking. Some tricked people into believing they could afford loans when they could not. Some actually falsified the numbers to make them look like they could work. Certainly, some consumers should have known better and made very bad choices. But too many others did not even recognize the risks they had taken on until it was too late. You were on the front lines. We're all now familiar with low doc and exotic mortgages. We know people took out loans they could not afford or could only keep up with for the first year or two. We know people signed onto complicated terms with no real comprehension of how the transaction worked. We know loan originators got kickbacks for putting families in higher cost loans than they actually qualified for. Our new mortgage rules will not allow such practices. Our loan originator compensation rule restricts certain practices that created financial incentives for pushing people into loans with higher interest rates than they actually qualified for based on their credit worthiness. And under our ability to repay rule, also known as the qualified mortgage or QM rule, lenders must now make a reasonable good faith determination that the consumer can actually afford the mortgage before they make the loan. Now, obviously, mortgage lenders do not have a crystal ball. They cannot predict if someone will lose a job or have an unexpected financial emergency. But they must look at a consumer's income or assets and at their debt and must weigh them against the monthly payments over the long term, not just a teaser rate period. Lenders can then offer any kind of mortgage they reasonably believe the borrower can afford to pay back. This is, in fact, the very foundation of responsible lending money based on a reasonable determination that you will get paid back. Our second back to basics approach affects the mortgage servicing market, which you know and I know performed so poorly in recent years. As housing counselors, you know how important mortgage servicers are to homeowners. They bear responsibility for managing the loans. They collect and apply payments to loans. They can work out modifications to the terms of a loan, and they handle the difficult foreclosure process. Because of all the things servicers do and the immense size of the $10 trillion mortgage market, their effects on borrowers and communities can be profound. New rules are all the more necessary because of the basic structure of mortgage servicing. For the consumer, this relationship often is not a matter of voluntary choice. After a borrower chooses a lender and takes on a mortgage, the responsibility for managing that loan can be transferred to another servicer without any say-so from the borrower. So if consumers are dissatisfied with their servicer, they have no opportunity to protect themselves by switching over to another provider. The fundamental disconnect between servicers and consumers was starkly revealed during the financial crisis. When the tsunami of delinquencies hit, you saw how problems worsened exponentially for homeowners. Servicers were unprepared to work with borrowers who needed help to deal with their individual problems. People did not get the support they needed, such as timely and accurate information about their options for saving their homes. Servicers failed to answer phone calls, routinely lost paperwork, and mishandled accounts. Consumers missed out on much needed help due to the indifference or incompetence of their mortgage servicers. Communication and coordination were so poor that many consumers thought they were on their way to a solution, only to find their homes being foreclosed upon. Sometimes people arrived home to find they'd been unexpectedly locked out. Sometimes people found themselves stuck in a nightmare of lost paperwork, even as the clock ticked on toward foreclosure. I am sure many in this room have had clients who've dealt with similar nightmares. I see heads nodding. To fix this broken system, the central principles of our mortgage servicing rules are no surprises and no runarounds. Simply put, consumers should not be hit with surprises by those responsible for collecting their payments. If a consumer takes out a mortgage to buy a home, our rules require servicers to keep the homebuyer informed about their loan and to investigate and fix errors. Consumers must be able to see how their payments are credited. They cannot be caught off guard when interest rates adjust. And they cannot be surprised by force-placed insurance, which often can be more expensive than the insurance borrowers can buy on their own. Our rules force servicers to be more transparent in this process, including advance notice and pricing information before charging consumers. Our new rules will help borrowers know where they stand. Consumers will not have to guess how much money they owe or when they owe it, because servicers now must send monthly statements showing how they credited the monthly payment. The statement puts all the important information in one place, showing the interest rate, loan balance, escrow account balance, and where the payments are going. And consumers will get ample notice when interest rates adjust. This is valuable, practical information to guide people's choices and actions, exactly what they need. And these requirements apply to all servicers other than the smaller ones, such as community banks and credit unions, which typically avoided problems by continuing to work closely with their customers throughout the financial crisis. To clean up the servicing market, we're also taking square aim at practices that have constantly given consumers the runaround. Our rules require mortgage servicers to treat consumers fairly when things are going well and also when people get into trouble. It's time to put the service back into mortgage servicing. So starting today, our new rules require some very basic things. For example, if you report errors on your bill or account, the servicer must investigate and fix any mistakes. For consumers in trouble, getting the runaround is not just frustrating, it can be disastrous. They need good information and actual help. Our rules require mortgage servicers to let consumers know about available options to save a home or work out a problem in making payments. Once borrowers become delinquent, servicers must give them instructions on how to obtain more information and begin a process that is intended to determine whether their homes can be saved. Servicers have to provide regular and dependable assistance when consumers call for help. No more endless phone trees or dealing with people who lack access to the relevant information. We're also restricting dual tracking by barring servicers from starting foreclosure proceedings until the borrower has been delinquent for at least 120 days. If the borrower submits a completed application for loss mitigation, no foreclosure sale can occur until all other available options have been considered. These options can range from deferring payments to modifying loans or even a short sale, among other things. And servicers cannot foreclose on a property once a loss mitigation agreement has been reached, unless the borrower fails to perform under that agreement. We expect these simple protections to help prevent needless foreclosures, which is best for borrowers, lenders, and our entire economy. These measures can often determine whether people save or lose their homes. This is not just an economic matter. We all know, for many, their home is the only safe place in their lives, the fundamental constant in their family relationships, and a key symbol of their progress in climbing the ladder to success in life. Those deep emotional attachments show just how much is at stake here. I'd like to take a moment to correct an erroneous myth that these new measures will bog people down in red tape. On the contrary, these measures are not new at all. They're exactly what good community banks and credit unions have been doing for many, many years. They amount to little more than taking the time to work directly with customers to address their personal circumstances. In short, our rules mean simply that mortgage servicers must now do their jobs. It may seem silly that we need rules to tell servicers to answer the phone, not to lose people's paperwork, to tell borrowers how much they owe. It also might seem silly we need a rule telling lenders they must pay attention to whether borrowers will be able to repay the money that is lent to them. But we have lived through the financial crisis. We've seen with our own eyes the grave dysfunctions in the mortgage market. There was an embarrassingly long list of things that should have happened but never seemed to happen. Our new rules are aimed at setting things right again. We mean to end a failed process in which too many struggling homeowners have been kept in the dark about where they stand. Too many Americans have been forced to roll this rock up the hill repeatedly, only to see it roll down again. People deserve better. They're entitled to be treated with respect, dignity, and fairness. Our new servicing rules will help ensure that happens. Importantly, these new mortgage rules are now subject to federal supervision and oversight across the entire financial marketplace. It does not matter whether a loan is made by a bank or some other kind of financial firm. It no longer matters whether a bank or some other kind of company is servicing mortgages for the mortgage owner. The same basic rules and oversight apply. In particular, our mortgage rules are backed by the full supervisory and enforcement authority that Congress has vested in the Consumer Bureau and working in partnership with our state banking superintendents. We will be vigilant about overseeing and enforcing these rules. As we all saw in the lead up to the financial crisis, common sense turned out to be not so common. By bringing back the basic building blocks embodied in these rules, we will improve conditions for all Americans seeking to enter the housing market, as well as for those who are working to pay down their existing loans or struggling to stay in their homes. Today, we're very glad to take the time to walk you through the specifics of these rules. We urge you to help us spread the word about the benefits to your clients as well. Work with us to help educate the public about the specific ways they can look forward to a new and better marketplace. And if they experience problems with servicers that are not following these new rules, please let them know that anyone is welcome to file a consumer complaint on mortgage issues or on many other financial consumer issues at our website, consumerfinance.gov. Let me also say they're welcome to file complaints with their state attorney general's office and state banking superintendents. We will all work together to see that these matters are resolved. For those of you here today, if you have any further questions about the issues we will be covering, please go to consumerfinance.gov/mortgage to find out more. It's a great partnership for our new agency to be working with housing counselors and legal aid attorneys across the country. You have made and continue to make a crucial difference in many people's lives. When I served in state office in Ohio, we were hit by the first waves of the foreclosure crisis. We struggled to understand the issues, and we worked and worked to help people save their homes. Again and again, we found that nobody did that as well as HUD-approved housing counselors. Today is an important day because the Consumer Financial Protection Bureau is providing you with the kind of support you needed and deserved all along. Together, we can find renewed hope in what lies ahead. Our mutual goal is sustainable home ownership based on responsible lending and excellent customer service. Common sense, after all, serves the common good. Thank you.
Next, we have Chris Smith. Chris Smith is the manager of NHS Homeownership Center. Mr. Smith will share 3 homeowner stories that typify the experience of the clients NHA serves. Chris?
Good morning. My name is Chris Smith. I'm the Homeownership Center Manager for Neighborhood Housing Services of Phoenix. We're a nonprofit HUD-approved counseling agency. On behalf of Neighborhood Housing Services of Phoenix, our management staff, our CEO, Patricia Garcia Duarte, we welcome you here today. I've been asked to speak specifically about some situations that we encounter on a day-to-day basis, and more recently over the last few months, that probably would be different if these servicing rules had been in place. So I'm going to give you 3 stories, and really kind of to put it in perspective, I'm going to drill down a little bit as it relates to the actual rules itself to make sure that you could understand where I'm coming from. So one of the rules states that the clients have to be notified early in the process as it relates to various foreclosure alternatives. Right now, we see a lot of clients on the tail end of the process, so you may have a client that come to us when it's 8 or 9 months past due. With the new rules, it's going to be very imperative that these clients get engaged early in the process, where it's very possible that we could help save their home at month 3, 4 instead of month 9, 10, and 11. So that's going to be very important. Obviously, the communication, one of the rules states that the homeowner has to be notified within 15 days of the second mortgage payment being missed, which is critical and crucial for us to do our job as housing counselors. The other rule states that they must be informed about homeownership counseling agencies that are available to help them. I really do believe that a lot of clients that come to us, and we still have hundreds of clients that call our office on a monthly basis, they're the exception to the rule. There's still a lot of clients out there, thousands of people dealing with hardship issues that really don't even know that we exist. So I think the rules as it relates to making sure that there's early intervention and making sure that there's communication from the servicer standpoint to let them know that there's HUD-approved counseling agencies available to walk them and navigate them through the process. One of the other rules is to make sure that there's direct and ongoing access to servicer personnel. there are several stories that we've heard on the ground level with clients that have tried to get modifications on their own, and it's just not happening. They get lost in the cracks with these major servicers. They keep talking to various people every time they call somebody, and they can't get a direct access or direct answers as it relates to what's going on with their situation. And then the last thing is making sure that clients have a fair review process to make sure that the servicer is not doing what's in the best interest of them as servicers and or investors, but making sure that the servicer is doing the best interest of the client. So with that being said, I'm going to give you 3 scenarios as it relates to these new rules, and perhaps these scenarios would not have happened if these new rules were in place prior. So we'll have homeowner number 1 is a client that contacted us in the 11th hour, like so many of them do. Contacted our office on December 7th of this year, or last year rather, had a trustee sale date on December 17th. So again, if they had known about housing counseling agencies earlier in the process, they would not have waited to the last minute to contact us. So very, very important. In this particular case, the servicer was unwilling to postpone this, the trustee sale date. So we had to rely on our friends over at the Arizona Department of Housing and the Save Our Home Arizona program to really intervene and stop the trustee sale date. In this case, we're able to help the client, get the client the assistance that they needed. But I think the point is that if the client had known about our services earlier in the process, we would have caused, or the client would not have had as much grief as they did. And one of the unintended consequences of a client going through a process like this is their credit is really ruined through this process. So you can imagine if we get to a client at month 3 or 4 versus month 9 or 10, that's going to save the client a whole lot of grief and or saving their credit report as well. So in this particular case, the client did get assistance, so we did save them from foreclosure, but it was at the 11th hour. The second example that I have is another client, again, that contacted us in the 11th hour, contacted our office on December 5th of last year, had a trustee sale date approximately 10 days after on December 15th. And this is a client that had been working with a major servicer on their own. And Director mentioned the word runaround. We get that a lot where clients come to us, and unfortunately they've been trying to work with their servicer directly, and they have been getting the runaround. So these new rules are going to help those clients out there trying to get modifications on their own, and hopefully drive some of those clients to agencies like ours. So this client had been getting the runaround with the servicer for about 4 or 5 months, and unfortunately we could not intervene on this one. We reached out to the Department of Housing, and unfortunately they could not help us stop that foreclosure because of the processes they have in place as well. And this client lost her house right before Christmas, and she had been in her house for about 16 years up in northern Arizona. So you can imagine the grief and the heartache that particular family went through right before Christmas. Another client that we had been working with the client for about 4 months, going back and forth, and this is with us intervening with the client and the servicer, and going back and forth for 4 months, and the servicer opted to take the client out of one particular modification review and put them in a less favorable modification review. And under the new servicing guidelines, that's going to stop, and that's going to be very important because to the client, it's very transparent. They don't really necessarily know which option is better for them, one way or the other, what they're able to get and what they should get under, the guidelines. So it's very important that these banks actually follow the guidelines and their feet are held to the fire as it relates to the modification review. In this particular case, the client was offered an in-house modification rather than a HAMP modification, and the client actually ended up taking it. Can you imagine the client going back and forth for 4 months and really being frustrated, and at that point in time they accepted the modification because they wanted to move forward and kind of get it behind them. But at the end of the day, it was not the right modification as it relates to what they actually qualified for. So again, I commend you, Director, and the CFPB for stepping up and really making a difference in homeowners' lives. This is going to make a tremendous difference as it relates to the thousands of people that are actually still dealing with these issues. Some say that the foreclosure crisis is over. I say that it's not. We still have hundreds of clients calling our office on a monthly basis looking to get their situation resolved. We're dealing with a lot of clients that have secondary hardships, so they may have had a modification 3-4 years ago. Perhaps their income did not increase accordingly to that modification, step up in payments, and they're coming back to us because the house is still unaffordable. So we're going to see a lot of that moving forward. So this is going to make a tremendous difference as it relates to our work out in the field and at the ground level. So thank you.
Thank you, Chris. Thank you to NHS for all the good work that you do, and thank you to the housing counselors and legal aid practitioners in the room who are here today to learn about the new rules. We thank you for all the good work you do for Arizona. At this time, I'd like to introduce Professor Kathy Mansfield, who will be conducting the housing counselor training. Kathy joined the CFPB in 2013. She's a new employee to the Bureau. Kathy Mansfield is currently serving as a policy analyst at the CFPB. She has taught law since 1992 and is a professor of law at Drake University Law School in Des Moines, Iowa. Before teaching, she was an attorney at the Urban Indian Law Office of Community Legal Services in Phoenix, Arizona. Professor Mansfield teaches contracts, payment systems, and a variety of consumer law courses. Professor Mansfield.
Good morning, everybody. It's a real treat for me to be back in Phoenix, where I spent my practice career before I went into teaching. So thank you for having me. I am, as you can see, shorter than the podium, so I'm going to just step aside a little bit. Okay, there we go. So actually, you have a copy. Is there some way to deal with the feedback? Okay, great. Thank you. Okay, great. There's actually a copy of a very long guide called Help for Struggling Borrowers in your green folder on the right side of the folder. And you may want to turn to that while I'm doing this. And the PowerPoint slide actually has page references to the guide, so you can follow along, make notes if you want, and that sort of thing. So first of all, I have to do the disclaimer before any training, which is the presentation summarizes the mortgage rules finalized by the Bureau in 2013, but not a substitute for the rules. Only the rules and their official interpretations can provide complete and definitive information regarding their requirements. So with that said, okay, so as I said, it's meant to accompany the guide that you have in front of you. You'll see if you look at the guide, it's more detailed than the PowerPoint presentation, and there are footnotes, not because I love footnotes so much, but because I wanted you to be able to actually go read the statute on a particular requirement if you need to. So pretty much every sentence in that guide is footnoted, and if need be, you can go check out the actual regulations. And you'll see I'll refer to page numbers on the guide. If you want other people to have access to it, there are two ways to get to it on our website. Then you can go to our landing page for mortgage issues, consumerfinance.gov/mortgage, or there's also a link up here. Okay, so what am I going to talk about? Well, I am ambitious and hoping I will get through all of this, but it's possible that I will not. I will certainly get through the first two, and that is the new loss mitigation application process under the new rules that go into effect today, the foreclosure prohibitions under the new rules, charges and fees that can be imposed on a borrower, the process for resolving errors, the process for requesting information, and then requests for payoff statements. So we're going to launch right in. So first of all, as you may know, the rules were actually adopted in 2013, and there were some amendments to the rules. We have a very comprehensive access page where you can get all the Federal Register writings if you're the sort of person who's inclined to read the Federal Register. And the rules, of course, become effective today, so this is a banner day for the rules. Okay, so we're going to talk about specific requirements today, literally all the specific requirements that go into loss mitigation, et cetera. But there's also a general rule that requires servicers to adopt policies and procedures that are reasonably designed to achieve objectives that relate to a lot of the things that Director Cordray and all of our other speakers mentioned. And I actually put we put a copy of that section of the statute as an appendix to this guide because it's got just those general requirements. But they include, again, the things that we've been talking about: accessing and providing timely and accurate information, evaluating loss mitigation applications, facilitating oversight for compliance with the new rules, facilitating transfer of information when servicing transfers from one servicer to another, informing borrowers of their rights on error resolution and information requests. And then there's also some requirements on record retention. So I suggest that you take a look at that section when you have a chance. Whoops, one too far. And then, as Director Cordray mentioned, there is an exemption for small servicers. A small servicer is defined as a servicer that, together with affiliates, services 5,000 or fewer mortgage loans and services only mortgage loans they are an affiliate originated or owned, or if they're a housing finance agency. There's also a chart attached to the guide that has sort of a chart of who's covered if they're a small service or what rules apply. That chart has actually been updated, and we'll have an updated version of the guide with the updated chart available next week on our website. Okay, so first we're going to talk about applying for loss mitigation. So the process of applying for loss mitigation under the new rules, as you'll see in a minute, is a multi-step process. And so I'm going to sort of try and walk you through the timeline of what to expect from the time a borrower becomes delinquent through loss mitigation if possible, or foreclosure or some other resolution like that if not possible. So we're telling our consumers when we talk to them the same thing that you have in the excellent guide that I know your Housing Alliance prepared, which I got to take a look at yesterday. And that is to tell the borrowers to take the call from the servicer. We really want borrowers to take advantage of these rules by talking to the servicer in an attempt to see if there's a workout that's available. And then the other sort of general point is that a borrower does not have to be delinquent under the rules to apply for loss mitigation. So when we get to the section on actually applying for loss mitigation, you'll see that delinquency is not a prerequisite to applying. This is sort of an important thing. The rule provides that a servicer is only required to comply with the requirements for a single complete loss mitigation application for a mortgage loan account. But if servicing transfers to a new servicer, then the borrower can apply for another loss mitigation application. Okay. Small servicers have to comply with some of the rules that they're spelled out in the guide. Okay, so first of all, before we talk about the meat of the rules, these are, yes, absolutely.
Process for a borrower. But everybody is going to start fresh now as of January 10th. If they have been through the process, were you going to say this already? Am I stepping on you? Never mind.
He's my boss, I gotta let him talk, right? And actually, it is a very important point that today is a new day, and I will mention that again, but very important. Even if you're in the middle of a loss mitigation application right now, the new rules go into effect today, and I will say that again later. Okay, so first thing you need to do is identify some key dates that you will need to know and that you may not know when a client first comes to see you. And those key dates have to be identified because some of the rules run forward from the date of delinquency. Some of the timing on the rules runs backward from the date of a foreclosure or trustee sale. So the dates are quite numerous that you have to identify under the rules. These are all of them. The date of delinquency, 36 days later, 45 days later, 120 days later, the scheduled date of the sale, and then some dates before that, 37 days before, 45 days before, 90 days before. Again, you may not know all that when you first get a client in, but these are, your clients are going to get some different contacts and some different rights depending on where they are in that timeline. So first of all, we're telling people try and get your clients to apply as early as possible. I'm sure that's not a surprise to you. There's no deadline for completing loss mitigation, but you get more stuff, more rights, if the earlier that you apply. And in particular, for example, borrowers who submit a completed application 37 days or less before a foreclosure sale are not entitled to have the servicer comply with the loss mitigation evaluation. So that's just an example of the kind of thing where it's better to apply earlier. Okay, here we go. Director Cordray, here it is. Consider if it's appropriate to apply again today for all your open files with a loss mitigation pending. The new rules become effective today. Any borrower who is more than 37 days from a foreclosure sale today and files a complete loss mitigation application before 37 days before a foreclosure sale is entitled to an evaluation of a complete application under the new rules. So if you get a complete application in today and you are more than 37 days away from the trustee sale, you're entitled to all the benefit of the new rules, or your clients are. So very important.
If you have a client who went through the loss mitigation process, say last year, and they were denied, the rules say you get one crack at it, but anything that happened before January 10th, we have no idea whether it was done properly or not. So, and it certainly wasn't necessarily done under these new rules. So any client now can start again, and if you want to reapply at this point, it will be your first application. You get a go-round after January 10th, if that's useful.
That's absolutely right, and it is a different point, so I'm really glad you made that. Okay, so we start out with when is a delinquency. The key concept here is that even if there's a grace period, the delinquency for the regulations that define delinquency starts on the day of the missed or partial payment. So even if you have a client who gets a 5-day grace period before they have a fee assessed, they would be delinquent for purposes of those early intervention rules on the day that they only send in a partial payment or miss a payment. And then there's some examples in the commentary which are in the guide at page 14 and 15. You start counting, if you will, on the day after the missed or partial payment because the borrower has till midnight of that night to pay. So if the mortgage payment's due on the 1st, January 2nd is your first day for purposes of counting on all these deadlines that I'm about to talk about. Okay, finally, we get to the loss mitigation process. So the first thing that happens under the new rules is live contact from the servicer. This has to occur within 36 days after the missed or partial payment. And the rules require that the servicer make a good faith effort to reach the borrower or an authorized agent of the borrower. And I had a question about that earlier. The rule does talk about proving agency. But this contact has to be with the borrower or an authorized agent. And they have to try to talk to the borrower in person. It's the beginning of trying to encourage the borrower to contact the servicer early to start working out any issues that they have. So there's a few exceptions to this requirement. I'm not going to go through all of them, but the most important exception for your purposes, I think, is that if the borrower has instructed the servicer in writing to cease communication with the borrower under the Fair Debt Collection Practices Act, which you can do under that statute, then the servicer is exempt from this requirement. So we're suggesting that you consider having any borrowers who have sent that do not contact letter rescind the do not contact letter so they get the benefit of all this mandated contact with the servicer. Okay, so step one is that live contact. Step two, the next thing that's going to happen is that promptly after that live contact is made, the servicer has to tell the borrower about the availability of loss mitigation options if it's appropriate. So the information at this stage is general, it's not specific yet, but again, it's another contact from the servicer to the borrower saying, here's what might be possible for you. And then, of course, it's within the servicer's discretion to decide whether that's appropriate in a particular case. And the example the rules give is if the borrower says that they're simply going to be late with their payment, they don't necessarily have to comply with this requirement. But if the borrower is, in fact, having trouble, then they would. Again, there's an exception under FDCPA, same thing under the Fair Debt Collection Practices Act to that part of the rule. Okay, so we've now got 36 days, we have live contact, then we have promptly after that, we have this general information. The next thing that happens is within the 45-day limit, there's two things. One is that the servicer has to assign personnel to the account. meant to address one of the issues that Director Cordray talked about and that all of you today have talked about. The other is that the borrower is now going to get a written notice from the servicer. So this is the third communication from the servicer right after delinquency. So the personnel, between the day of the borrower's missed mortgage payment and 45 days later, the servicer is supposed to assign personnel to the mortgage and send a written notice. The personnel is meant to provide continuity of contact with the servicer. They have to assign personnel. It can be one or more persons. It doesn't have to be a single person, but it has to be a group assigned if it's not a single person. That person has to be available via telephone immediately or in a timely manner. They have to be able to provide the assigned personnel with access to all documents with information about that particular borrower. There should be facilitation of sharing of accurate information about the account among the various personnel who are assigned to the account. And then the personnel themselves should be able to respond to the borrower's inquiries. And that includes responding regarding accurate information about loss mitigation, telling the borrower what the borrower has to do to apply for loss mitigation, telling the borrower what the deadlines are for applying if there are any, telling the borrower how to appeal, telling them the status of any loss mitigation. You get the theme. It's, you know, that these personnel are supposed to be able to actually communicate with the borrower about what's going on with the account. The personnel are supposed to remain assigned to the borrower until the borrower has made 2 consecutive mortgage payments under a permanent loss mitigation. So that same group of personnel should be assigned to that account during that entire period. Okay, next is a written notice. And so now we've got the third contact from the servicer to the borrower once the borrower becomes delinquent. The timing on this is between the day of the borrower's missed mortgage payment and 45 days later. The servicer has to send the written notice to the borrower or to an agent. It has to be sent regardless of earlier contact. And the notice is quite extensive. The requirement is quite extensive. I didn't put everything up on the slide here. It's on pages 22 and 23 of the guide. But it has to encourage the borrower to contact the servicer, give the borrower telephone numbers to contact the servicer, give examples of loss mitigation that might be available, give them an application, and this is the part you're going to be very interested in. This is what Chris was talking about. At 45 days, they're going to get this letter that gives the borrower a website address and the HUD toll-free number so that they can get access to you guys. So that's at 45 days. And then the form has to be clear and conspicuous. There's a model form, so you may see that being used by servicers for this part. Again, this is one of those sections that is currently exempted under the FDCPA, so if your borrower has sent a do not contact letter under the Fair Debt Collection Practices Act, the servicer does not have to provide this writing. Again, you may consider asking your borrower if they want to rescind that do not contact. Okay, then the next requirement or the next contact is actually from a different part of the rules, so it takes a little bit of explanation. So the new rules, as Director Cordray mentioned, require that servicers send a periodic statement to borrowers that has information about their loan. So if it's a monthly payment, the borrower is going to get a monthly periodic statement that will give them information about their loan. There's some exceptions if a coupon book is given at the initiation of the loan, but regardless of whether the borrower is getting a coupon book or a periodic statement, once they become delinquent, they have to get yet another notice under the periodic statement rule that tells them that they're delinquent. So that's the requirement here. So once the borrower's been delinquent for more than 45 days, the servicer or mortgage owner or assignee must send the borrower certain information grouped together in close proximity. It can be either on the periodic statement or it can be on a separate piece of paper that complies with this. And this is the information, the key information that has to be on there. The date the borrower became delinquent, and account history. I think this one's very important. An account history covering the period since the account was last current for the last 6 months, whichever is shorter, and showing for that period the amount past due from each billing cycle. So that's a lot of information that's going to go out on that periodic statement. The borrower has to be told whether foreclosure has started or not, how much has to be paid to bring the account current, and again, they're going to get the contact information to find a housing counselor. Okay, so there are a few exceptions to this requirement, and guess what? One of them is the FDCPA no contact exclusion. So same comment on that. Okay, so now we've had a bunch of contact from the servicer to the borrower, right? We've had that live contact, we've had promptly after, we've had the written communication, we've gotten the written notice, we've gotten the periodic statement. Hopefully the borrower has come to see you and they are now primed to apply for loss mitigation. And so the next thing I'm going to talk about is the actual application for loss mitigation. Okay, so first of all, I want you to sort of take note that I'm going to use the words application, complete application, and facially complete application, and they mean different things, so just take note of sort of what I'm talking about each time. So the first thing we're going to talk about is determining when a borrower has applied for loss mitigation. It's crucial because once the borrower has applied, there are certain responsibilities of the servicer that are triggered. So we need to know what's an application for loss mitigation. So here's what the rules say. An inquiry about loss mitigation in which the borrower provides no information to the servicer is not an application. But if the borrower does provide any information that would be evaluated as part of a loss mitigation application, then that is an application. So if the borrower gives any information that the servicer would require as part of the loss mitigation application, the borrower has now applied for loss mitigation. Sorry, I want to go back for a minute, which is just the commentary says that the word application should be considered expansively, okay? If servicing on a mortgage account is transferred to a new servicer, documents and information transferred from the old servicer to the new servicer may count as an application. You'll be happy to hear, I think, triggering all of the responsibilities under this regulation. Okay, there are some general rules about sort of completing those applications once they're made. One is a general rule that says that the servicer has to maintain policies and procedures that are reasonably designed to ensure the servicer can identify documents and information that a borrower is required to submit to complete a loss mitigation application. So that's just one of those general requirements on the servicer. Okay, so remember when I talked about those deadlines? This is one of those things where it matters when the complete application comes in for purposes of what kinds of rights the borrower is going to get. If the application, not the complete application, if the application is received 45 days or more before a scheduled foreclosure sale, the servicer has to promptly review the application to determine if it's complete and send the borrower a written acknowledgement saying that the servicer received the application, telling the borrower if the application is complete, and this has to be done within 5 days. And probably most important, if the application is received during this 45-day before sale time period and the application is incomplete, the servicer has to tell the borrower what additional documents and information are needed to complete the application. So that is a very crucial deadline because you want your borrowers to get that 45-day notice that says you need these 5 documents and these 2 pieces of information to complete your application. The servicer has to give the borrower a reasonable date by which the application should be completed. There's a lot of stuff about what is a reasonable date. You'll find that at page 29 through 30 of the guide. The servicer also has to exercise reasonable diligence in getting documents and information to complete the loss mitigation application, and there's examples of due diligence in the commentary that are also discussed in the guide. Okay, so this is why the 45 days is crucial. If the application is received less than 45 days before a scheduled foreclosure sale, the servicer is not required to provide that written acknowledgement that tells your client if their application is complete and what they need to do to complete it. So that timing is very crucial. If the application is incomplete when received during this time period, 45 days or less before the foreclosure sale, the servicer still has that general obligation to exercise reasonable diligence to help obtain documents, but the written notice part is not required. Okay, so once the borrower submits a complete loss mitigation application, that's when they're entitled to evaluation of the application. So we've now hopefully had the initial application. If we're more than 45 days, we've got that letter from the servicer saying you need these 5 or 6 documents to complete your application. Now we want the borrower to actually complete their application. Obviously, you want some way to track for your borrower that you've submitted what was requested in that 45-day letter. Once there is that complete loss mitigation application, there's evaluation. There's no deadline for completing the application, but the sooner it gets in, the better. That won't surprise you to hear. Oops. And the evaluation has to be conducted by the servicer within 30 days of the servicer receiving the complete loss mitigation application. So you send that information in, 30 days later, you should have a complete evaluation from the servicer. Okay, if the application is received more than 37 days before a scheduled foreclosure sale or before any foreclosure sale is scheduled, those applications have to be evaluated for all loss mitigation options available to the borrower. And then again, making the point that Director Cordray made and the related one that I said, that it's a new day today, and so any borrower who's more than 37 days from a foreclosure sale today can apply for loss mitigation. Okay, an application is complete when the borrower gives the servicer all the information that it requires from the borrower. If the servicer is waiting for information from somebody else, that doesn't impact whether the application is complete, as long as that borrower has sent in what the servicer has requested. The servicer can establish its own complete application requirements, but of course they have to tell the borrower what those are. Okay, so am I going backwards here? Great. There we go. Sorry about that. Okay, what happens if a complete application, I think I went backwards again. Okay, what happens if the servicer receives the complete application 37 days or less before a foreclosure sale? If the application comes in 37 days or less before a foreclosure sale, the servicer does not have to evaluate the application for loss mitigation. So 37 days or less is really the time period where it's going to be very difficult to get the borrower evaluated for loss mitigation. It's possible the owner or assignee will have requirements for applications that come in during that time period, but the rules do not mandate the review during that time period. Transfer of servicing. Okay, if servicing is transferred while the borrower's complete loss mitigation application is being evaluated, there's some rules about what has to go to the transferee servicer. So first of all, the transferee servicer has to get all the documents and information that the borrower gave to the old servicer as part of the loss mitigation process. Also, if the documents constitute a complete loss mitigation application for the transferee servicer, the servicer has to treat them as if they were submitted to the new servicer on the date that they were submitted to the old servicer. So if servicer A and B require the same documentation for a complete loss mitigation application, servicer A gets that complete loss mitigation application, servicing is transferred, which would have to be in that 30-day evaluation window, to servicer B, and that would be a complete application for servicer B. Servicer B has to pick up the evaluation. The transfer, I know, I always love it when the audience says, that's really good. That happens once in a while. It's cool. Okay, the transferee servicer is supposed to continue the evaluation to the extent practicable. Okay, then there's this concept. So we've now talked about applications and complete applications. Now we're going to talk about the facially complete application rule, which is somewhat complicated, but very important rule. Okay, let's say the borrower submitted all the information that was requested in that acknowledgement letter, right? The acknowledgement letter said you need these 5 documents to finish your to finish your application, borrower gets that in. Or the letter said you didn't need to submit anything else. If the servicer later determines additional information or corrected documentation is required, then the application is considered what we call facially complete. So what does it mean if you submit a facially complete application? Well, first of all, the servicer has to promptly request the missing information or corrected documents. The servicer has to treat the application as if it was complete for purposes of the foreclosure protections, which we're going to talk about in a minute. But basically, if you've got a complete application pending, it halts the foreclosure. So you get that protection, and also until the borrower is given a reasonable opportunity to send in the later requested stuff. If the borrower completes the facially complete application during that period, the foreclosure protections continue. The application is considered complete as of the date it was facially complete for purposes of the borrower's rights for appeal and other things. And then the 30-day evaluation timeline doesn't start until the later documentation comes in. So the borrower basically gets those protections from the date that they complete what the servicer requested. Okay, and this is the last thing on evaluating applications, but it's an important one, which is there are two small situations I'm not going to talk about but are in the guide. But other than that, the servicer can't evade its obligations to evaluate a complete loss mitigation application by offering a loss mitigation based on evaluation of information provided in connection with an incomplete loss mitigation application. In other words, they can't like do a quick review before the application is complete. Again, there are two little exceptions and they're in the guide. Okay, so what happens next? Next is an offer or denial of loss mitigation within 30 days of receiving that complete loss mitigation application. The servicer is going to have to give the borrower a written notice. The content of the notice is going to depend on whether they're offering loss mitigation or denying loss mitigation. So first we're going to talk about what happens if an offer is made. So if an offer is made by the servicer to the borrower after they've filed this complete loss mitigation application, the notice has to say what loss mitigation offers are being made and tell the borrower the amount of time the borrower has to accept or reject the loss mitigation program as provided for in this cross-reference. An offer that involves non-home retention, like a short sale, can be conditioned on receipt of further information. Okay, if the applicant is denied for a loss mitigation application, there are certain rights if the denial is related to a loan modification. And it's very important that you see that this is only relevant to loan modification denials. In that case, the written notice has to give specific reasons for the denial if they're denied for any loan modification, trial or permanent. If the borrower is rejected because of investor requirements, the servicer has to identify the specific owner, assignee, investor, or guarantor whose rules mandated the rejection and specifically identify the requirement that is the basis of the denial. Specifically identify. It's not sufficient to say an investor requirement required us to deny you. And if a trial or permanent loan mod is denied because of the net present value calculation, the servicer has to provide the borrower with the inputs that were used to calculate the net present value, not just say you're being denied because of a net present value calculation. Finally, the servicer has to notify the borrower of any rights to appeal the decision to deny, and the requirements for appealing and the time the borrower has for appealing. Okay, so now we're going to go back to what happens if there's an offer. So if the servicer decides to offer a loss mitigation option to the borrower, the servicer can prescribe the deadline for the borrower to accept that offer. It depends on when the completed loss mitigation application was received. If it was received 90 days or more before a foreclosure sale, the servicer has to give the borrower at least 14 days to accept or deny or reject the offer. If it was received between 90 and 37 days before a foreclosure sale, the servicer has to give the borrower at least 7 days to accept or reject the offer. If there's no foreclosure sale set, the borrower gets the advantage of the greater time. In other words, they're treated as if that it was more than 90 days. If the borrower doesn't respond to an offer by the deadline, the servicer can treat the failure to respond as a rejection of the offer. So, you know, we need borrowers to respond within the time given by the servicer. There are a couple exceptions. Those are also discussed in the guide. And then a borrower whose complete loss mitigation application results in a denial for a loan modification has a right to appeal the denial if the servicer received the complete loss mitigation application 90 days or more before a foreclosure sale. So this is one of those things where one of the reasons why it's best to get that application in early, right? Because you lose that appeal if it's not filed, the complete loss mit isn't filed by 90 days before the sale. You'll notice here this rule also applies only to loan modifications, not other loss mitigation offers. Other loss mitigation denials. Okay, the appeal has to be taken within 14 days after the servicer provides that written notice of denial. And the appeal has to be conducted by different personnel than the ones who denied the loan modification in the first place. And then if the borrower does appeal, the servicer has to respond to the appeal within 30 days, including they may decide to make an offer or they may decide not to make an offer. Okay, there's a couple other things covered in the guide about loss mitigation that I'm not going to talk about today, but you can look at them. One is what can they offer loss mitigation to a borrower who has not applied for loss mitigation? The general answer is generally no, unless it's a broad program set for specific groups of people. And then there's also a little discussion about the intersection with the Fair Debt Collection Practices Act. And there is a private right of action for failure to comply with this particular section, 12 CFR 1024.41, which is the loss mitigation process that I just described. Okay, so I think we're ready to move on to foreclosure prohibitions. So we've gone through the whole loss mitigation application process. In tandem with that, the rules also have some prohibitions on when a servicer can initiate a foreclosure. So the first thing I have to talk about is obviously we're federal and there are 50 states and everybody starts foreclosures differently in every state. So the rules talk about what it means to file a foreclosure. And I don't think I'm going to read through this, but we're basically talking about the first initiation of whatever the process for foreclosure is, but I highly recommend that you look at those rules and see how they dovetail with Arizona's rules on foreclosing. Okay, the good stuff, the prohibitions. Okay, as Director Cordray pointed out, there is a 120-day prohibition period from the date of delinquency. And that rule says a servicer, and this covers small servicers as well, cannot file, and I use that word to represent, again, whatever the initiation process is here, for any judicial or non-judicial foreclosure during the first 120 days that the borrower is delinquent. What do we hope is going to happen during that 120-day period? We hope the loss mitigation process that I just described will be going on during that 120 days. There are a couple exceptions that are in the guide. I'm not even going to worry about them. The rule applies to loans that are delinquent today, the day the rules go into effect. Servicer also cannot file for foreclosure if the borrower submits a complete loss mitigation application before that foreclosure is initiated. Again, this is meant to allow time for evaluating the complete loss mitigation application before the foreclosure gets started. The next one is, so that prohibition on filing when there's a complete application pending lasts until one of these three things has happened. Number one is the servicer has denied the application and the appeal process is not available, or the time for appeal has expired, or the appeal was turned down, or until the borrower has rejected any offers made, or until the borrower does not perform as required under a loss mitigation resolution. So basically, the concept is the foreclosure freezes while the loss mitigation application is running its course. A servicer also can't file for foreclosure at any time if the borrower is performing pursuant to a short-term payment forbearance program. And then a servicer can't file for foreclosure if a borrower is performing pursuant to the terms of any loss mitigation agreement. Okay, what if the foreclosure's already been started? What happens then in terms of prohibitions on foreclosure? And that's what we'll talk about next. Okay, if the borrower files a complete application more than 37 days before a foreclosure sale, even if the foreclosure's already been filed, then this is what happens. The servicer cannot move for a foreclosure judgment, including a dispositive motion, like a motion for default judgment or on the pleadings or a summary judgment, or for an order of sale, or conduct a foreclosure sale until one of the following three things has happened, and it's the same stuff we just looked at. So basically, again, if the foreclosure has started already, the borrower is more than 37 days away from that foreclosure sale, and they file a complete loss mitigation application, basically the application's going to have to be evaluated and ruled on before the case can go to a foreclosure judgment or sale. What happens if the application is filed more than 37 days before the foreclosure sale? Once the servicer receives the complete loss mitigation application, it has to promptly instruct any lawyers it has retained not to proceed with the foreclosure. The call off the lawyers paragraph, right? They also can't conduct a foreclosure sale, and if necessary, the lawyers are supposed to file for a continuance, which is a delay, with respect to any deadlines for filing motions with the court. The servicer can continue litigating and arbitrating, et cetera, otherwise, and if the servicer has already made a dispositive motion at the time the complete loss mitigation comes in, the servicer has to take reasonable steps to avoid a ruling on the loss mitigation. On the foreclosure sale order. Okay, so those are the prohibitions, and good, we still have time. Those are the prohibitions on filing for foreclosure and the loss mitigation process. The next thing we're going to talk about is charges and fees. So first of all, what about applying full periodic payments? So this is what happens next. When full periodic mortgage payments come into the servicer is required to credit the payment as of the day the payment is received. There are two limited circumstances or exceptions. A full mortgage payment a full mortgage payment is defined as a payment that's sufficient to cover principal, interest, and if insurance and taxes are escrowed, then that would be included as well. A payment is still a full mortgage payment even if the borrower doesn't pay amounts that are required to be paid for late fees. So as long as that principal interest and, if applicable, taxes and insurance is paid, that's a full mortgage payment. And then payments are deemed to be received when the instrument reaches the mortgage servicer. So that means, like, if the check comes into the mortgage servicer, that's the day it's received. So long as not prohibited by other law, the servicer, or by the contract between the parties to the mortgage, a partial mortgage can have the following treatment. It can either be credited on receipt, returned to the borrower, or it can be put in a suspense or unapplied funds account until the borrower has paid enough to make a full payment. Once enough money has been paid into a suspense account to cover a full periodic mortgage payment, the servicer has to treat the funds like a full mortgage payment, which means they have to be credited. The servicer also has to tell the borrower on that periodic statement that we talked about before, they have to say the total amount that's being held in the suspense account, the total of payments received since the last periodic statement, and the total of all payments received since the beginning of the current calendar year, which ought to help you track what the status of the account is, right, when the clients come into you. There is, moving on, there's a limitation on pyramiding late fees in the new rules. Servicers aren't allowed to impose a late fee or a delinquency charge on a mortgage payment if the fee or charge is attributable solely to failure of the consumer to pay a late fee or delinquency charge on an earlier payment, and the payment is otherwise a full periodic mortgage payment. Okay. Force-placed insurance. There are extensive requirements about force-placed insurance. They're covered in great detail in the guide. I'm going to go relatively quickly through them here. So, first of all, the guide talks about what is force-placed insurance. I'm sure most of you, if not all of you, know what that is. And then when the servicer can purchase and charge the borrower for force-placed insurance. Basically, a servicer is allowed to purchase and charge the borrower a premium and a fee for force-placed insurance if the servicer has, and this is a quote, a reasonable basis to believe the borrower has failed to comply with the loan contract's requirement to maintain hazard insurance. The guide also talks about how the borrower can prove that they have hazard insurance in order to avoid having force-placed insurance put on the account. And then there's also a process outlined in the guide and in the rules for what has to be done before force-placed insurance can be purchased. Basically, there's a series of notices. There's a first notice from the servicer that has to be sent at least 45 days before charging the borrower for the insurance. Then there's a second or reminder notice from the servicer that has to be no sooner than 30 days after the first notice and at least 15 days before charging the borrower. The content of that second notice is going to vary depending on if the borrower has sent in nothing in response to the first letter or sent in something that the servicer thinks is insufficient in response to the first letter. And then the next thing that will happen if those first steps don't result in proving coverage is that the servicer can purchase and charge the borrower for the insurance. But again, not until those first two notices have gone to the borrower. In terms of what can be charged for force-placed insurance, it has to be bona fide and reasonable. And the commentary says bona fide and reasonable means it has to be a charge for a service actually performed that bears a reasonable relationship to the servicer's cost of providing the service and is not otherwise prohibited by applicable law. And then the only exception to that bona fide and reasonable requirement in terms of the amount that can be charged is for charges subject to state regulation as the business of insurance and charges authorized by the Flood Disaster Protection Act of 1973, which, having lived here, I know can actually apply here, perhaps. You would think in the desert that wouldn't be true, but... Okay, the next section is on renewing and replacing force-placed insurance. Same thing, there's 2 notices before that's done. Then there's also a section on canceling force-placed insurance. Okay, how many of you have heard of a qualified written request? Probably most of you, right? Okay, these two regulations replaced the qualified written request regulation. And so we've now divided it into error resolution notices and requests for information. So I'm going to talk about both of those. First of all, error resolution. What happens, or how do you start the error resolution process under the new rules? Well, the first thing that happens is the borrower has to send a written notice to the servicer asserting an error. The guide talks about what is an error and what counts as a written notice. I put what I thought were the highlights up here. A written notice can't be on a payment coupon, so you want your borrower to send something separate. It can be a qualified written request, so if you use an old form that had the qualified written request, that's fine. And the servicer has to determine if the submission is a notice of error based on the content, not the title of the document. So they have to kind of read the document and see if it looks like it's asserting an error. And then there's a section on where the borrower should send the notice of error, so you should take a look at that. Okay, next thing that happens is the servicer acknowledges receiving that notice of error within 5 days, excluding weekends and holidays. And then the servicer has to investigate the notice of error and respond to the notice of error. The investigation basically says the servicer has to correct the error, and if they don't correct it right away, they have to investigate. They can ask the borrower for documentation that supports the error, but they can't require the borrower to provide information as a condition to assessing whether or not an error was made. And they cannot require the borrower to pay a fee in order to have the error resolution process take place. The servicer will investigate. The response is basically dictated by the rule. It says what they have to do if there is an error, how they have to respond if they don't think there's an error, what happens if they find different errors, that sort of thing. And again, that's covered in detail. Okay. So I think this is a very key element. Once the servicer receives a notice of error, it cannot furnish adverse information about the borrower to a credit reporting agency for 60 days. This is not true with the request for information, and it's a big difference between those two. So if you send a notice of error, that's going to stop the credit reporting agency from hearing about an alleged problem for 60 days. A servicer who's received a notice of error can still pursue other remedies it has under the law, even while they're looking at the error. Of course, you get the benefit of all the foreclosure prohibitions that we talked about earlier. Okay, information requests, very similar process. The borrower sends in a request for information, the servicer acknowledges receipt, then the servicer responds to the information request. There's stuff in the guide about the timing for the response and how they have to respond. Same thing, they can't charge a fee to provide the information requested. And unlike with error resolution, as I just said, while the servicer is responding to the request for information, the servicer can report to credit reporting agencies, so very important difference. There's also information available on periodic statements, so I'm not going to cover that in detail here, but I know the director talked about it when he made his remarks, and you may be able to get some crucial information to assist your borrowers from those periodic statements, if you can get those from your borrower. There's also some stuff about requests for payoff statements in the guide. And then the last two things I wanted to say were, first of all, we have a landing page now on our website at the Consumer Financial Protection Bureau. This is what it looks like. It's consumerfinance.gov/mortgage. And you'll see that we have help for home buyers, for homeowners, and understanding our mortgage rules. And if you go to that page, it has helpful things for professionals like you, and then it also has helpful things that are meant to be for consumers directly. It stopped advancing. There we go. Okay, the other thing is, as the director mentioned, we do take complaints directly from consumers. In your green folder, there is a brochure on how to file a complaint, so you have that with you. Plus, you can also go to our website, where one of the first links you'll see is submit a complaint, and that's what that looks like when you link to it. And then I want to leave you with, we will eventually have a process to hear directly from advocates such as yourselves. We'll have a place for you to let us know what you're finding on the ground. That should be up and running very, very soon. Until then, you can either email Chris Vaith in External Affairs or myself, and we will pass that information along. And I thank you for your attention. I know it's a long run through the rules, and I'll turn it back over to Zixta. Thank you.
Thank Kathy again for the wonderful job she did. And I want to reiterate my thanks to everyone here for joining us to talk about the new mortgaging servicing rules, which are in effect today. And I want to reiterate my thanks to you for the important work that you do on behalf of your clients in Arizona every day. Thank you. That concludes the CFPB's housing counseling training in Phoenix, Arizona at the Burton Barr Central Library. Thank you all for taking the time to join the CFPB today, and thank you to all who watched via live stream at consumerfinance.gov. Have a great afternoon.